Hello. So what is an underlying mortgage when you're buying in a co-op building? An underlying mortgage is an original loan taken out by a co-op to finance the purchase of the building and usually the land that it occupies. It's called underlying because it comes before or under any personal loans that individual shareholders have taken out to purchase their apartments. Co-op buyers should know that these underlying mortgages are paid for in their monthly maintenance fees. Now, in the cases where these mortgages have been paid off, the shareholders' maintenance fees should drop considerably, but this rarely happens, as I'll explain shortly. When you buy a condo or townhouse, you don't have an underlying mortgage. The financing you're offered is a first mortgage, and the lender takes your real estate as collateral. When you buy a co-op unit, the financing available to you is called a share, or typically a co-op loan, and it's backed by your co-op shares. It's very important to find a lender who understands the unique structure of New York's co-op buildings. This means you should really work with a New York City-based lender whose firm will be experienced in financing co-op purchases. If you want to work with one of the big retail banks like Chase, Bank of America or Wells Fargo, that's fine. But you should deal directly with their New York City offices, not your local branch, or by calling their 800 number. This will save potential confusion and delays in the process, which can be inconvenient and possibly prove costly. Buying a co-op apartment, you own shares in a corporation, which in turn owns the building and usually the land, like I said. Unlike a condo, the entire property can have a permanent long-term loan. Now, some might think that a co-op would prefer to prepay some or all of their underlying mortgage. Many will enjoy a large number of flip tax payments or income from a commercial lease, for example. But what typically happens is that co-op buildings continue to age and require both periodic upgrades and major repairs. The replacement of a boiler, roof, elevators, windows, renovations of common areas, etc. can easily run into the millions of dollars over time. Boards prefer to avoid increasing the shareholders' monthly maintenance or having assessments whenever possible. Paying off their mortgage obviously involves a larger principal payment as well as an interest payment. So most co-ops have underlying mortgage with interest-only payments that keep their maintenance fees down. Also note that shareholders can use the interest on the mortgage-related portion of those dues as a tax write-off. Now, when a payoff does happen, it's mostly smaller co-ops of say 4 to 10 units, or a larger building that used the proceeds from selling off a valuable commercial space on the ground floor, for example. So there you have it. Let me know if you have any interest in buying or selling in New York City, or if you have any real estate questions. Cheerio for now.